Welcome to the Deep Dive. This is where we gather some of the most rigorous research and the sharpest thinking in finance, stack it all up, and really distill the key insights you need to navigate the markets today.
Absolutely. Glad to be here.
So today we're undertaking, I think, a really deeply psychological mission. We're diving into the mind of one of the most influential quantitative investors out there, Cliff Asness. He's the co-founder and CIO of AQR Capital Management. And our goal isn't just, looking at spreadsheets. It's really exploring that very human desire that drives so many investors that wish to capture market returns without feeling any of the fear or the volatility or the pain that usually comes with it. Asness's work, it fundamentally challenges this whole fantasy. He argues that the most powerful evidence-based solutions, they're often the simplest ones. They just require disciplined action and, frankly, psychological fortitude.
Yeah, that's a great way to put it. What's fascinating here is that Asness is kind of the antidote to financial anxiety, isn't he? He sees this entire industry constantly trying to engineer some complex product to solve what's really a deeply human emotional problem, that fear of loss.
Exactly.
And if you look at his work, his message is pretty clear.
Yeah.
Simplicity and discipline aren't just a solution. They're usually the best long-term solution, even when, they feel absolutely terrifying in the moment.
And the urgency here is, well, it's palpable. We're living in an era that's almost defined by this massive surge in manufactured complexity. Products designed to smooth out returns, they're literally everywhere. We're talking about options trading, a strategy that used to be just for sophisticated institutions.
Oh, yeah.
It's gone completely mainstream now.
It really has transformed almost overnight, it feels like. If you just look at the scale, it's pretty remarkable. A few years back, Morningstar was tracking something like, $60 billion in what they called hedged equity funds. Now, that whole category of options trading-related funds, things like buffer ETFs, defined outcome funds, all that jazz, it's ballooned to north of $230 billion.
Yeah.
And that capital isn't exactly flowing towards simple index funds, is it? It's chasing that promise of complexity.
And crucially, this complexity, it's become democratized, right? Options trading is now super accessible, often kind of gamified on digital platforms.
Yeah.
You see these buffer ETFs marketed so aggressively with that incredibly tempting promise. Hey, we can protect you from a market slide. The pitch feels simple. Get most of the upside, skip the downside.
And that promise, that's the real flashpoint for Asness's skepticism. It hits him immediately. He kind of sees his role, and maybe the whole quant community's role, as challenging that sort of financial fun. He actually said, I consider my job to make it less fun for you because I think some of these things have gone too far.
Wow.
He's instantly cynical about anything that claims to offer free or even cheap insurance in a system like the capital markets. A system that's supposed to be highly efficient and, let's be honest, rarely gives anything away for free.
Okay, let's really unpack that core cynicism. Let's start with what he calls the buffer trap, because this is where the money really meets the mechanics of it all.
Right. So buffer funds or defined outcome ETFs. They're really the perfect example of this complexity born out of anxiety. Their stated goal is pretty straightforward. Get basic stock market exposure, like to the S&P 500, but then use option contracts, the right but not the obligation, to buy or sell stock to strategically shape the distribution of returns.
Shape the distribution. Okay.
Yeah, they're trying to do two things at once. Cut off the worst losses while only giving up a sort of predefined slice of the biggest gains.
So it sounds like they're trying to build this synthetic safety net. Now, we know the simplest version might just be buying the index and then buying a put option like stock insurance. But you mentioned the reality of these buffer products is way more complex than just one put. How do they actually construct that payoff curve? How does it work?
Well, they typically engage in what's often called a collar, or sometimes a really highly customized synthetic hedge structure. It usually requires buying and selling multiple contracts at the same time, often 4, sometimes even more. So, for instance, they might buy the S&P 500 index exposure. Okay, simple enough. Then, to finance the insurance they need, they often sell a call option. That limits your potential upside on the index.
Right, selling the call generates premium.
Exactly. And that premium they receive helps pay for a protective put option, which establishes the floor, the downside protection. But then, to really fine-tune that floor and the ceiling, they might use another layer of puts and calls, maybe options that are deep out of the money or in the money, all to create this very specific, defined band of returns for the investor.
Okay, that level of structural opacity, I mean, it's overwhelming for the average person, right? You almost need a PhD to figure out what 4 simultaneous option positions are doing to your returns on any given day.
Absolutely.
Yeah.
And that structural complexity, it completely obscures the fundamental financial concept. Asness keeps stressing, which is really the cornerstone of his whole argument. The equity risk premium, or ERP. The ERP is simply that excess return. Historically, it's often been several percentage points a year that investors get for holding risky things like stocks instead of low-risk stuff like cash or treasury bond.
And crucially, this return isn't just a gift, is it? It comes with a cost.
Precisely. It's a compensation we demand collectively for enduring volatility. Asness calls volatility and the risk of those scary drawdowns the price of admission. He even says the scary part is probably why you get paid. So if you could reliably just eliminate that scary part, the downside, without giving up a proportional chunk of that long-term premium, well, the market would figure that out pretty fast and arbitrage it away. The ERP would basically vanish. You're fundamentally paying someone through fees or complexity to take away your expected future returns.
Okay, but wait, let me push back a bit on the psychology here. For an investor, maybe someone retired relying on the 4% rule. Isn't locking in a floor on their capital a huge psychological benefit? Isn't that peace of mind, that guaranteed reduction in anxiety during a crash? Isn't that worth paying a premium for, worth sacrificing some upside?
That's a really crucial question, and it speaks directly to the psychology of money, absolutely. But I think Asness would argue that if your goal is genuinely psychological peace, you should probably use simple, transparent tools. The big problem with the complex buffer fund is that the empirical evidence, the actual data shows, it often fails to deliver that promised peace. So the emotional and financial cost might just be redundant.
Okay, let's get to that empirical failure then. What did AQR actually find when they analyzed the real-world performance of these complex strategies?
Well, the data is, let's just say, overwhelmingly unfavorable to the buffer funds. AQR did a really rigorous review. They compared the performance of these complex, options-based products against the simplest, most transparent alternative you can think of. Just a straight mix of an S&P 500 index fund and cash.
Okay, simple benchmark.
Very simple. And the finding was pretty damning. The vast majority of buffered funds they looked at underperformed that simple index cash mix.
Okay, underperforming is one thing you might expect to give up some upside for safety, but did they actually deliver the safety? Did they protect the downside?
Not reliably, no. And this is the crucial part. AQR found that a majority of the analyzed funds actually had larger drawdowns than the simple cash and stock portfolio.
Wait, larger drawdowns, how is that even possible?
It's a truly disastrous outcome, isn't it? You paid for expensive, complex insurance, you got worse returns overall, and you still experienced deeper losses when the market actually tanked.
That just runs completely counter to everything these products advertise. How can buying insurance possibly result in larger losses than just holding some safe cash?
Yeah, it seems backwards.
Yeah.
But you have to look closely at the specific type of market pain where these option strategies are, well, uniquely ill-suited, the grinding bear market. Think about that market slide we had in 2022, or even the slow, drawn-out decline during the global financial crisis.
Right, not a sudden crash, but a slow bleed.
Exactly. These are periods of continuous, slow, really nerve-wracking losses, not those sudden, sharp, single-period crashes like, say, the COVID drop in March 2020.
And the options, they're designed more for that massive sudden spike in volatility, right?
Precisely. Options deliver their maximum theoretical payoff during those sharp, sudden, extreme moves down. But in a slow, continuous decline, a real grind, those massive single-day moves are usually absent. So the protective put options, they never really realize their full potential value. Meanwhile, as the market just keeps bleeding lower and fear rises, what happens to the cost of protection, the options premium? It constantly increases. Insurance gets more expensive.
Ah, okay.
So the strategy is forced to perpetually pay these high rising premiums for insurance that never fully kicks in. And that creates this severe compounding drag on performance.
So the strategy is just consistently hemorrhaging cash on these premium payments, which ultimately eats away at the very capital that was supposed to provide the buffer in the first place.
That's the buffer trap in a nutshell. The complexity hides the fact you're buying very specialized protection for a scenario that rarely plays out perfectly. And you're paying this high recurring cost that consistently drags down your returns, pretty much regardless of the market environment. Asness's recommendation, based purely on this empirical data, is unequivocally clear. He says, I won't mince words, we recommend against buffered funds.
Okay, so if that manufactured complexity, often sold via high-fee products, empirically fails to outperform, the alternative that Asness champions is, well, it's so straightforward, it's almost financially boring, isn't it? Yet it seems demonstrably superior, just combining stocks and cash.
It really is the absolute epitome of simple wisdom. If you, the investor, are genuinely nervous about your risk exposure, The direct, zero-cost, completely transparent solution is just to sell some stocks and increase your holdings in highly liquid, low-risk cash equivalents, like T-bills or a money market fund.
Yeah, it doesn't require complex derivatives or understanding option Greeks like delta and theta or paying layers of management fees. It's just rebalancing between two basic assets.
Exactly. If you decide on, say, an 80% stock index and 20% cash portfolio, well, you get 80% of the upside during bull markets. Pretty simple. And you automatically reduce your downside exposure by 20%. That's it. This is the traditional battle-tested strategy, the one, as Asness puts it, your grandma and grandpa told you to invest that way. It's liquid, it's transparent, and it's dirt cheap.
And crucially, AQR's analysis showed that this simple combination often beat those supposedly sophisticated buffer strategies that were specifically designed to smooth returns.
Yeah, it's the ultimate lesson in just avoiding being too clever for your own good, isn't it? Asness' simple advice for the nervous investor really cuts through all the noise. Sell some stocks, real simple. This is too cute by half is another way to put it. Why introduce 4 layers of option complexity with all that inherent drag when you could achieve arguably superior risk mitigation with just 2 perfectly liquid, low-cost components?
And this philosophical preference for simplicity, it extends really deeply into the behavioral side of things, too. The massive value and the profound difficulty of simply doing nothing during turbulent periods.
Oh, absolutely. This is where the psychology of money really hits home hard. We are just hardwired with loss aversion, aren't we? Yeah. When the market is dropping, we feel this intense, almost physical compulsion to do something, to act, to move money, find a clever hedge, change strategies, anything but sit there. Asness treats market timing with, as he says, great cynicism, even when it's practiced by professionals who think they know better. He emphasizes that doing nothing is surprisingly often the right strategy.
But emotionally, gosh, doing nothing when your portfolio is shrinking day after day, week after week, it feels like a massive failure. It feels like, as sources described it, white-knuckled terror for about a year. How do we justify paying that emotional tax?
You justify it by remembering the historical reward, that ERP we talked about. That white-knuckled terror is the emotional price of admission you're paying for the long-term premium. And the immense value of enduring that terror is that you prevent yourself from making the single most destructive mistake investors typically make, making those reactive and stupid portfolio changes.
Like selling low.
Selling low, locking in losses, and this is critical, missing the inevitable, often very sharp rebound that frequently follows the worst of the volatility. You have to be in it to win it back.
So the discipline required just to stick to that simple stock and cash mix during a really protracted downturn is maybe paradoxically the most valuable financial skill you can actually cultivate.
It really is. It's the ultimate alpha generator for the retail investor.
Yeah.
Behavioral alpha. It's just sticking to your plan when your lizard brain is absolutely screaming at you to run for the hills.
Yeah.
And we have to remember the source of all this temptation to get clever, right? Wall Street's incentives.
Yeah, the financial industry doesn't really profit from simplicity, does it?
Absolutely not. Wall Street's profitability model is fundamentally rooted in selling the new, the complex, and the high-fee product. Asness uses that great analogy of a car lot, where they sell new and used stocks. There's basically zero incentive for them to advertise the fact that the empirically superior solution for managing your anxiety is probably just to combine 2 basic, cheap inputs, a stock index and cash, and then just sit tight for decades. That doesn't generate many fees.
Right.
So the investor's ultimate goal has to be to filter out all that noise, reject that constant temptation to get clever, and really anchor themselves to the empirically proven power of simplicity.
Okay, so we've established that simplicity seems to be the key to rational long-term investing. But Asness has this really fascinating, almost, heretical view that in the modern world, rationality might actually be losing ground. He suggests that markets have actually gotten less efficient in recent years because of behavioral and structural shifts.
It does seem like a contradiction at first, doesn't it? We've got instant data feeds, algorithms trading in microseconds, informational efficiency, just the speed at which news gets baked into the price that's faster than ever before, no question. But Asness is talking about a deeper kind of efficiency, long-term valuation efficiency. And that type is driven primarily by human behavioral errors and persistent biases. And what technology, particularly social media, has done is basically amplify those errors.
Right, that amplification mechanism is social media. It acts like gasoline poured on our existing behavioral biases.
He draws a very sharp, very contemporary analogy there. He asks, if social media has seemingly poisoned our voting mechanisms in politics, why would it not affect our markets? It's a fair question.
Yeah.
A stock's price at any given moment is essentially a collective voting mechanism on its future value.
Yeah.
So when social media platforms consolidate and then amplify a collective, often uncritical vote may be driven by hype or momentum or just sheer excitement, it can drive extreme, persistent inefficiency in valuations.
The whole meme stock phenomenon is obviously the textbook example of that digital mob mentality, just completely overriding fundamentals, at least for a while.
Oh, absolutely. It's the most concentrated, maybe purest case. But Asness argues this irrationality actually exists on a spectrum. Even successful, profitable companies like, say, Tesla or Palantir, which definitely have real underlying fundamentals, he suggests they exist on a spectrum of inefficiency. Why? Because they possess, in his words, a very meme-like component where they're a little cultish.
Interesting.
That emotional energy, that shared digital narrative pushed by the crowd, it can drive prices far beyond what any sort of rational discount rate or fundamental analysis would suggest.
And this crowd, this digital mob, is increasingly being fed products specifically designed for instantaneous, high-stakes psychological engagement. We're talking about the sheer gamification of finance.
This is perhaps the most alarming trend that comes through in the sources. This complete merger of entertainment, pure gambling, and traditional investment platforms all in one place. You now have stocks, crypto, sports betting, often facilitated by the exact same brokerage interfaces. It turns investing into a kind of high-stakes game. And the perfect storm, the ultimate expression of this trend, might be the single-day option, or zero DTE, zero data expiration contracts.
Options that literally expire within hours or even minutes of being bought. That just sounds like a financial lottery ticket, pure and simple.
Asness doesn't mince words at all. He calls zero DTE the FanDuel of finance. He states it pretty matter-of-factly. Nobody's ever needed that in history. These contracts, they aren't designed for prudent risk management or hedging complex positions. They're high-stakes, extremely time-sensitive vehicles optimized purely for speculation and gambling behavior. They leverage that very human desire for massive immediate gains.
And financially, why are they such a demonstrably bad deal for the average participant who tries to trade them?
It comes down to the premiums, almost entirely. The expected value of these lottery tickets is just overwhelmingly negative for the buyer. The immense volatility involved and the incredibly short time frame, the premium you pay, the cost of the ticket, basically is disproportionately high relative to the actual probability of a significant payoff. Asness predicts these contracts are going to be very bad deals for investors because they consistently pay way too much premium. Who benefits? The brokerages and the option sellers. They get spectacularly rich at the expense of the speculator.
So it's the ultimate complexity, but it's catering directly to a fundamental behavioral bias. The promise is that huge, immediate return, playing right into our human weakness for instant gratification and, FOMO, fear of missing out.
Absolutely. The brokerages profit immensely because the investors are paying these excessive premiums just for that shot of adrenaline, that chance at a quick win.
Yeah.
The vast majority of players lose money, generating immense friction, immense cost for the system overall.
This brings us right back full circle to that classic wisdom from Warren Buffett, which Asness clearly anchors on. In the short run, the market's a voting machine, but in the long run, it's a weighing machine.
Exactly. The short-term mob, that digital voting machine, it drives prices to irrational extremes. Think meme-fueled valuations, the zero DTE trading frenzy. But the fundamental anchor, Asness believes, remains. Ultimately, truth wins. Over the long haul, the rational long-term weighing machine is the reality of fundamental cash flow, profit, asset value. That's what dictates the price.
Yeah.
The emotional short-term betting frenzy eventually ends when fundamentals take over. Asness is a firm believer in that weighing machine. But the big psychological challenge, the thing he can't solve, is the total unpredictability of when that shift from voting to weighing actually occurs. It could take years.
Okay, so if the solution to market anxiety isn't manufactured complexity like buffer funds, and we know the market is still plagued by these sometimes manic swings, how should a sensible, evidence-based investor actually manage risk? Asness seems to guide us to shift focus away from mitigating volatility with tricks and towards managing risk through intelligent fundamental portfolio structure.
Yeah, he fundamentally argues that we should probably stop viewing volatility as some enemy that has to be avoided at all costs. In many ways, it's the necessary friend of return. Volatility isn't a bug in the system. It is the necessary cost of admission if you want to earn that equity risk premium we talked about. The only risk we truly need to manage, he suggests, is taking on more volatility than we can psychologically tolerate. tolerate without panicking and selling everything at the market bottom.
So it's much more about aligning your portfolio's actual risk level with your personal emotional tolerance, rather than trying to somehow engineer away all the price swings.
Exactly right. And he's also really quick to criticize what he terms volatility laundering. That's what happens when certain illiquid assets, like some private equity or private real estate funds, report these unnaturally smooth, low volatility returns. They appear safe simply because they aren't priced frequently, maybe only quarterly or annually. It masks the true underlying risk, but it appeals directly to the investor's desire for those smooth-looking returns. Asness advocates for transparency. Understand the real volatility you own and actually lean into appropriate risks when the prices seem right. Don't hide from it.
Beyond just tolerating volatility, the bedrock of successful structural risk management has always been true diversification. What does Asness mean, though, when he calls for true diversification? What does that look like?
He means introducing investment engines into your portfolio that move independently of the traditional stock market. We're really looking for assets that are genuinely uncorrelated. People often confuse hedging and diversification. A negative correlation means one asset tends to rise when the other falls. That's a hedge, like buying puts. But an uncorrelated asset, well, knowing what it did today gives you basically no information about this other one. It's a genuinely separate engine of return that just marches to the beat of its own drum, regardless of what the S&P 500 is doing.
And these uncorrelated strategies, they're often the domain of sophisticated hedge funds, right? Using strategies like market-neutral long-short portfolios.
That's definitely where AQR's quant expertise really shined. They achieve this kind of independence often through systematic long-short strategies. For instance, they might simultaneously buy, say, 1,500 stocks they expect to outperform based on specific quantitative factors like value or momentum. And at the same time, short sell 1,500 stocks they expect to underperform based on those same factors.
Okay.
If they execute it correctly, the net result should be, ideally, a small positive stream of returns that has near zero correlation to the S&P 500, meaning when the market is up 20%, maybe the fund is up 3%, but when the market is down 20%, the fund might still be up 3%. It's independent.
Right, but the classic criticism, you hear this all the time, is that if I allocate, say, 20% of my capital to a conservative market-neutral strategy like that, I'm reducing my exposure to the stock market, I'm sacrificing potential growth, especially during a raging bull run. You can't eat risk-adjusted returns, you need actual returns.
That's a totally valid psychological and financial challenge, and it leads to one of Asness's arguably most brilliant practical solutions, the idea of equitizing the alternative.
Yeah.
This solution basically turns that uncorrelated return stream into pure added value, or as he calls it, just gravy, without actually sacrificing your overall market exposure.
Okay, equitizing the alternative. Let's break down the mechanism behind that. How does that actually work?
Yeah, it's really powerful in its efficiency. The investor doesn't just do a simple allocation like 80% stocks and 20% to the alternative fund. No. Instead, they allocate the bulk of their capital, maybe all of it, to the uncorrelated fund, that long-short strategy we talked about. And then simultaneously, they add a simple, very cheap S&P 500 future contract on top of that.
Okay, why use a future specifically instead of just buying an S&P 500 index ETF or something?
Futures are incredibly capital efficient. You only need to put up a small fraction of the total contract value as margin, often 5% or even less. This leaves the vast majority of your capital completely free to work and generate those uncorrelated returns over the long-short fund. So the end result is a portfolio that maintains 100% market beta exposure via that efficient futures contract. And then the positive uncorrelated returns generated by the long-short fund are essentially added right on top, almost entirely unconstrained by the cost of getting that beta exposure. That is the essence of the gravy. Pure alpha on top of beta.
We definitely have to address the elephant in the room here, though. That widespread feeling, especially among U.S. investors, that diversification has basically failed them over the last 15 years or so. U.S. large-cap tech stocks, in particular, have just overwhelmingly crushed pretty much every other asset class globally.
Yeah. Asness argues that this sentiment is incredibly geographically biased, and it really misses the underlying structural truth. Diversification always works, in the sense that it reduces portfolio volatility. It just doesn't guarantee you will always capture the single best performing asset class return in any given period. Nobody can promise that.
Yeah.
That huge U.S. outperformance wasn't solely driven by superior organic growth or earnings. A huge chunk of it came from massive multiple expansion.
Meaning U.S. market valuations, the price investors were willing to pay for a dollar of earnings, just got way, way higher relative to international markets.
Correct. U.S. stocks just got much, much more expensive relative to the rest of the world, and that drove a lot of the return. Now, for a globally diversified investor outside the U.S., that U.S. multiple expansion was actually a headwind to their relative performance. But for a non-U.S. investor, diversification was highly effective during that period. Expecting that extreme U.S. valuation premium to just keep expanding indefinitely from today's already expensive starting point. As Asness thinks that's very naive. He believes the global diversification trade is actually set to reassert its value, making broad global exposure potentially more critical now than it has been in a long time.
Okay, finally, let's turn to the real cornerstone of AQR's investment philosophy, value investing. Asness starts by defining the core idea that cheap securities tend to outperform expensive ones over time, not just as a philosophical belief, but as an established empirical fact.
Yeah, the historical evidence he points to is pretty overwhelming. It spans nearly a century now. That value premium, the excess return you get on average by buying assets that look cheap based on fundamental measures like book value or earnings or cash flow, it's evident across something like 87 years of U.S. equity data. It's been documented in over 40 countries worldwide, and even across a dozen different asset classes, things like commodities and currencies too. Value seems to be a pretty foundational structural element of how financial markets work.
But the popular idea of value investing, it's so heavily tied to specific, often idiosyncratic success stories, right? Like the concentrated stock picker, the Warren Buffett model. Asness labels this specific narrative fiction, concentrated value.
Right. The myth is that successful value investing must require some unique, almost innate skill set to analyze companies deeply and then hold just a handful of stocks in a highly concentrated portfolio. Buffett himself famously said that diversification is protection against ignorance, which kind of suggests that if you're skilled enough, well, you don't really need diversification.
And Asness uses a really great analogy to sort of debunk this singular focus on the genius stock picker.
Yeah, it's the famous George Burns analogy. Burns, the beloved comedian, right? He smoked 10 to 15 cigars a day for something like 70 years, and he lived well past 100. Now, just because George Burns achieved that exceptional anecdotal outcome doesn't mean smoking is healthy or that we should recommend it to the general public, obviously.
Right.
Similarly, Buffett's unique, concentrated success, while incredible, shouldn't just override the decades of rigorous, systematic evidence showing that diversified value investing works reliably across markets and time. Systematic diversified value should be accessible, he argues, probably at a low fee, and seen as separate from the much higher stakes game of concentrated stock picking.
Okay, the next fiction he addresses relates to supposedly new products. Is there really a genuine innovation in strategies like fundamental indexing or smart beta? Are they something truly new?
As Asness states pretty bluntly, that fundamental indexing is only systematic value investing, just packaged differently. That's it. It is simply a rules-based value tilt. These products weight stocks based on fundamentals like sales or dividends rather than just market capitalization. What does that do mechanically? It systematically overweights the cheap stocks, which naturally have higher fundamentals relative to their low price, and it underweights the expensive, often frothy growth stocks. And the data confirms it completely. Fundamental indexing loads gigantically on value. So arguing that it's somehow fundamentally different from traditional value investing is, in his view, just confusing and maybe a bit disingenuous.
So new packaging, maybe, but effectively the same underlying strategy. But here's perhaps the most crucial finding for the modern quant investor. As Asness openly admits that value, when viewed as a standalone factor, actually has a major weakness.
It's true. And it's important to acknowledge, value by itself is surprisingly weak, especially among large-cap stocks. Historically, its standalone premium has often been statistically insignificant for long stretches. So for a systematic manager, just relying on large-cap value alone can lead to really long, painful periods of underperformance, triggering that white-knuckle terror we talked about earlier.
That definitely sounds like a structural vulnerability if you're just a pure value investor. How does the quantitative approach, AQR's approach, overcome this inherent weakness?
The real breakthrough, he argues, is combination specifically, the multi-factor approach. The key fact is, combining value with two other well-documented, proven factors, namely momentum and profitability, nearly doubles the long-term Sharpe ratio. That's the standard measure of risk-adjusted return. Remember, momentum is just the empirical tendency for recent winners to keep winning, and profitability favors those high-quality firms with robust margins and strong balance sheets.
Okay, but value and momentum, intuitively, they seem like they should be mortal enemies, don't they? Value is all about buying what's beaten down and unpopular. Momentum is about buying what's already soaring and popular.
That tension, that apparent contradiction, is precisely their secret weapon when used together. They are strongly negatively correlated over time. Think about it. When value is suffering, like during the big tech boom in the late 1990s when cheap old economy stocks were just languishing what was soaring,
Right.
momentum driven by those high-flying growth stocks.
Right.
Then, when the value factor finally corrects and comes roaring back, like after the tech bubble burst, momentum usually lags because those previous winners crash. This reliable negative correlation provides immense diversification benefits within the equity portfolio itself. It smooths out the returns dramatically and significantly reduces the severity and, importantly, the duration of drawdowns compared to using either factor alone.
So it's like the ultimate psychological shield built into the strategy itself. Even if the value factor on its own were to somehow generate zero expected future return from here, its diversification benefit, when combined with momentum, would still make it an incredibly valuable tool to have in the portfolio just for risk reduction.
That is the absolute genius of the systematic multi-factor approach. It utilizes empirical data, historical patterns, to fight that natural psychological urge to panic and abandon a strategy during its inevitable down cycles. By combining these two basic, powerful, yet negatively correlated engines, value and momentum, the investor creates the kind of psychological fortitude needed to actually stick with the strategy long term. Why? Because hopefully when one part is struggling, the other part is holding steady or even thriving. #outro. So to really synthesize Cliff Asness's powerful, I think very empirically grounded message for you, the investor listening today. First, reject that manufactured complexity. Be deeply skeptical of financial products like buffer funds and especially zero-day options that promise some kind of free insurance or easy ride. They usually come with hidden costs.
And instead, trust the simple, accessible truth. Often, a straightforward blend of stocks plus cash is the superior, more transparent, and empirically proven form of protection if you need to reduce risk.
And remember that psychological reality. Volatility isn't the enemy you need to vanquish.
Yeah.
It's the necessary price of admission. It's the cost you have to pay to potentially earn that equity risk premium over the long haul.
Yeah, the financial world might be a short-run voting machine, often driven by fleeting mob psychology and social media hype. But your commitment, your strategy, needs to be anchored to the long-run weighing machine. That means betting on fundamental value and proven evidence-based strategies over just emotional reaction or chasing clever, high-fee tricks.
And remember, the most accessible solution, like simply holding stocks in cash and doing nothing, is often the one that demands the most psychological fortitude from you. That seems to be the fundamental nature of financial markets. As this is final kind of provocative thought, really addresses the market froth we might be seeing today. He asks, basically, whether this current era of speculation will end in fire, sudden, sharp crash, or if it ends in ice, a long, slow, grinding deflation of the balloon.
And the truth is, we just don't know the timing, do we? And that unpredictability is probably the greatest risk to our own peace of mind as investors. But what we hopefully do know, based on this discussion, is that adopting a simple, diversified, maybe factor-based process gives you the kind of structural resilience you need to weather fire, ice, and really every emotional test the market throws at you in between. So now we really want to hear directly from you. Have you ever felt the allure of these complex financial products? Or maybe you've successfully navigated a really tough downturn by sticking to a simple stock and cash strategy. Your experiences, your feedback, they're truly invaluable to us, and they genuinely help us figure out what topics we should deep dive into next. Thank you so much for making us a part of your intellectual curiosity today. Please consider sharing this deep dive with others who might benefit from hearing the data behind simplicity. And definitely subscribe so you don't miss our next conversation.
Until then, keep digging beneath the surface, folks.
We'll see you next time on The Deep Dive.